You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is Tuesday, January 27th, 2025. And today we are looking at Union Pacific. Now, before we get the train rolling, pun intended, just a quick reminder that everything you hear is just our personal opinion, definitely not financial advice, so please do your own homework. Okay, Miro, Union Pacific, Q4 2025. Scanning the headlines, it looks surprisingly robust. I mean, profits are up, EPS is up. It feels like a solid beat. But I saw you frowning at your screen for the last 20 minutes, so I'm guessing there's a catch.
There is always a catch, Susie, but this one is architectural. Look, if you just read the press release, it's a victory lap. Diluted EPS hit $3.11. That is a record. It is up from $3.01 last quarter. Net income rose to $1.85 billion. So on the surface, great execution.
Right. $3.11 a share is nothing to sneeze at. That's solid growth.
It is, until you ask how they got there, because the actual business of moving freight, that shrank. Revenue declined 2.5% to $6.09 billion. Operating income, which is, the money they make from actually running trains, fell 6% to $2.4 billion. So, they didn't beat the quarter by moving more boxes. They beat it by being a real estate company for a month.
Oh, wow. Okay. That is the definition of paper profit, isn't it? It's like saying, honey, I got a raise when you actually just sold the second car.
Exactly. And the market sniffed it out immediately. You saw the open, right?
Yeah, it gapped up, right? I saw 235 at the bell.
It did. It popped to 235-ish, probably on the headline EPS number, but then gravity kicked in. Traders read past the first paragraph. It faded pretty much instantly. End in the day, down about 1%, closed around 232.55. It was a classic pop and drop. The algorithm buys the headline, the human sells the details.
Yeah, and I imagine the weather didn't help the mood either. I was reading the transcript, and Jim Vena, the CEO, he spent a lot of time talking about that ice storm in the South, Texas, Louisiana. It sounded pretty brutal.
It was. And to be fair, weather happens. But what concerns me isn't the snow, it's the efficiency. The operating ratio, the holy grail of rail metrics, it went the wrong way. It worsened to 60.5%. Remember, for them, lower is better. Last quarter, they were at 59.2. So you have falling volumes, rising costs, and a one-time real estate sale holding up the roof. It's a quality of earnings issue, plain and simple.
Quality of earnings. That is the polite accountant way of saying smoke and mirrors.
I prefer creative stabilization.
All right, let's dig a little deeper into that stabilization, because if the core business is shrinking, we need to talk about what happens when you run out of industrial parks to sell. Let's get into the details.
Yeah, well, that is exactly where the math gets messy. Because if you strip out the land sale, you are left with the core engine. And right now, that engine is running hot. Remember that operating ratio number? 60.5%?
Right. It got worse.
It did. But here is the nuance that everyone is missing. Usually, when a railroad's efficiency metric gets worse, it's because they lost control of costs. But this time, I think they actually chose to make it worse.
So they chose to be less efficient? That doesn't sound like the railroad playbook. Usually it's cut to the bone with these guys.
Historically, yes. Precision scheduled railroading PSR was all about stripping assets down to the studs. But listen to Vena on the ice storm recovery. The network got hammered in Texas and Louisiana. Usually, that kind of weather event breaks a supply chain for weeks. But they recovered to 70% fluidity in days.
Oh, I see, because they had extra crew sitting around.
Exactly. They're carrying what they call a buffer. Excess locomotives, guaranteed pay for crews who aren't working. That is expensive. It drags down margins. It hurts the operating ratio. But when the storm hits, it is the difference between a hiccup and a heart attack.
So it's basically an insurance premium. They're paying for reliability, which, honestly, customers have been screaming for years.
They have. And Vena even made that crack about how this isn't your grandmother's railroad, which, by the way, is a great line, but let's be real. My grandmother was very efficient.
I bet she was. Okay, so they're trading margin for resilience. That's actually a strategic pivot. But Miro, If costs are structurally higher because of this buffer strategy and revenue is shrinking, where does the EPS growth come from in 2026? Because they can't just sell an industrial park every quarter.
That is the billion-dollar question, literally. And this is where we hit the brick wall. Usually, a railroad defends its EPS with share buybacks. When operations get tough, they buy back stock to engineer the growth. But look at the 10Q. Buybacks are fully paused. Zero.
Because of the merger?
Because of the Norfolk Southern deal. They are hoarding cash to pay for it. So think about the position they're in. 1. Operations are more expensive because of the buffer strategy. 2. Revenue is shrinking. 3. The buyback lever is broken off until the deal closes. They are flying without a parachute right now.
And that deal isn't exactly smooth sailing, is it? We briefly touched on the regulator, the STB, delaying things, but you seemed particularly annoyed by what they were asking for.
It is absurd, Susie. The STB asked them to disclose their walkaway price, their red line for the deal.
Wait, isn't that illegal? Or at least terrible negotiating strategy?
It is suicidal negotiating strategy. Imagine you are buying a house, and the bank forces you to tell the seller, by the way, I am willing to pay up to $5 million, but not a penny more. What do you think the seller does?
They ask for $4.99 million.
Precisely. It destroys your leverage. Venna tried to play it cool on the call. He said, I don't see the benefit, but we'll give it. But you know he was grinding his teeth. If that number becomes public, Norfolk Southern shareholders have all the power, or a rival bidder steps in knowing exactly what to beat.
That's wild. It's like playing poker with your cards taped to your forehead.
Worse, it is like the dealer turning your cards over for you. So you put all this together. You have a regulator actively sabotaging your negotiating position. You have a pause on buybacks, leaving you naked on EPS, and you have structural inflation, 4% labor inflation, by the way, eating into your margins.
Okay. When you stack it up like that, the record EPS headline feels a lot more fragile. It's like they're walking a tightrope in a windstorm and the regulator just greased the wire.
A very evocative image. But yes, the buffer strategy keeps the trains moving, but it doesn't fix the balance sheet problem if the merger drags on. And remember, they're targeting closing in the first half of 2027 now. That is a long time to go without buybacks.
Yeah, a long time to rely on, what did the CFO say? Muted economic forecasts?
Muted. That is the polite word for it.
So yeah, let's step back for a second and think about what all this means for where they're actually heading.
Well, if you look at the map for 2026, it looks like a grind, a real slog. They are forecasting mid-single-digit EPS growth, which is fine. But remember, they have 4% labor inflation baked in now.
Right. And usually the railroads just pass that cost on to the customer, right? They have that pricing power. But Jennifer Heyman, the CFO, she actually flagged this. She said price might not be the driver for margin improvement this year. That felt like a subtle warning bell to me.
It was. It was an admission that the easy leverage is gone. If inflation is running at 4% and the economy is muted, you can't just hike rates 6% and expect customers to swallow it. So without buybacks and without massive pricing power, they have to rely on efficiency.
Which brings us back to that operating ratio. They need to get efficient again, but they're committed to this buffer strategy to keep the trains running during ice storms. It feels like they're trying to serve two masters, resilience and margin. And right now, the math is fighting them.
Exactly. It is a tension they haven't resolved. To me, the outlook is basically a waiting room. They are parking capital, maintaining the network, and staring at the calendar until the first half of 2027 when the Norfolk Southern deal might close.
That is a long time to sit in the waiting room, Miro.
It is. Investors are basically holding an option on that merger closing with a dividend to pay for the patience. But for the next 4 quarters, I think we are looking at a very boring, very defensive stock.
Well, Jim Vena did say if you want to open a coffee shop, build one across the street. I guess for now, Union Pacific is just focused on brewing their own coffee and ignoring the noise.
Let's hope it stays hot.
Indeed. All right, that wraps up the financial detective work for this week. It's a messy quarter, but hey, at least the trains are moving.
Most of them anyway.
Always the realist. Thank you for listening to Earnings Unscripted. We'll catch you on the next one.
Take care.
And actually, just before we fully sign off, a quick look behind the curtain. What you are listening to right now, Earnings Unscripted, is actually a bit of an experiment. We are a project built by a small team of enthusiasts exploring the frontier of AI, trying to see how these tools can be used to actually enrich us. This entire episode was created by a team of AI agents, from the research analyst digging through the 10Q, to the scriptwriter, to the fact-checking QA specialist, and yes, even the voices of myself and Miro. We are all working together to try and deliver high-density, up-to-date information that would be incredibly hard to produce otherwise. We are really curious to know what you think. If you have questions, comments, or just want to chat, please reach out at earningsunscripted@datamadness.ca or follow us on X.
See you after the next call.